I will discuss IT stocks, which stands for Information Technology. Stocks are typically categorized into two groups, defensive and cyclical. Defensive stocks perform well when overall market sentiment is negative, while cyclical stocks, often referred to as growth stocks, tend to thrive during robust economic cycles. Let me illustrate with an example. The IT sector is considered defensive. In the scenario of an unfavorable economy where our currency weakens, IT companies develop software and export their products overseas, receiving payments in dollars. This economic downturn and currency depreciation actually benefit IT stocks, causing them to perform better when the overall market is experiencing a downturn. Similarly, pharmaceutical stocks exemplify this. From 2008 to 2014, a period following the Lehman Brothers collapse, when the market was not performing well, consider Sun Pharmaceuticals. While the market struggled, Sun Pharmaceuticals' stock price surged from 100 rupees to 200 rupees between 2008 and 2014. Even during the COVID-19 pandemic and lockdowns, IT stocks have performed exceptionally well. The reason for this is that IT professionals can work remotely, primarily involved in software development. However, there's an interesting twist this time. The Indian rupee has actually depreciated, going from about 72 rupees to nearly 83 rupees against the dollar over the past year, marking a roughly 12% currency depreciation. Despite these circumstances, IT stocks have not fared well. For reference, if you visit the NSE, National Stock Exchange website, you'll find that as of March 23, 2023, the Nifty index, which represents the broader market, has experienced a modest decline of about 1.38% over the last year. However, when you examine the IT index, it tells a different story, with a significant drop of 22.38% during the same one-year period. To put it simply, while the Nifty decreased by 1.38%, IT stocks faced a substantial decline of 22.38%. This is noteworthy considering that the Indian rupee depreciated from 72 to 83 rupees per dollar during this period. Currently, there are challenges facing IT stocks that deviate from the usual defensive trend. Typically, IT companies develop and sell software to foreign firms, with a significant focus on three industries: banking, financial services, and insurance, often referred to as BFSI. However, the recent scenario is different due to a series of bank collapses in the United States over the past 10 to 15 days. Silicon Valley Bank and a couple of other banks, including First Republic Bank, are among those facing significant financial trouble. In Europe, Credit Suisse faced a collapse but was subsequently taken over by UBS. The impact of these bank collapses is twofold. Firstly, these troubled banks may no longer be purchasing software from IT companies, and even if they had made prior purchases, the financial instability means payment may not be forthcoming. Secondly, when banks merge or are acquired, it often results in a reduction of customers for IT companies. For example, if an IT firm sells software to both UBS and Credit Suisse, and these banks merge, the IT firm now has only one customer instead of two. The global trend of mergers and acquisitions in the banking sector is thus reducing the income potential for IT companies. Additionally, the ongoing interest rate hikes in the United States are creating further challenges for IT stocks. As interest rates continue to rise, banks face increasing challenges. When interest rates climb, borrowers may struggle to repay their loans, potentially leading to defaults. This situation was evident during the 2008 financial crisis, when many borrowers couldn't meet their obligations, resulting in a market crash. The outstanding loan amounts often exceeded the value of the properties, causing borrowers to stop repayments, which in turn created significant problems for banks. In periods of exceptionally high interest rates, banks tend to adopt a more cautious approach. They aim to control their expenses, which includes reduced spending on software products. Although the rupee has depreciated from 72 to 83 in the short term, banks, given their existing financial challenges, might request IT companies to reconsider product pricing due to currency devaluation. While short-term currency depreciation might appear favorable for IT stocks, it's important to consider the long-term perspective. Contracts are likely to be revised and renegotiated, especially when US banks, facing financial difficulties, become more cost-conscious. Even minor expenditures on software products will be scrutinized closely. Currently, looking at the screen, it's evident that several IT companies are either at or near their 52-week lows. Mphasis is trading at a 52-week low, Infosys is very close to its 52-week low, and Wipro is also experiencing a similar situation. Wipro has experienced a significant decline of 40% over the past year, while Mphasis has fallen by 43% and Infosys by 27%. Even L&MT Technological Services has seen a 31% decrease in its performance. These substantial underperformances suggest structural changes in the IT stock landscape. The ongoing challenges in the IT sector are likely to persist until US inflation is brought under control and the US Federal Reserve stops raising interest rates. A potential scenario of decreasing interest rates in the US could stabilize the IT industry. It's worth noting that IT companies are now more diversified, not solely dependent on the US market. However, the issues in Europe, particularly the banking problems, exemplified by Credit Suisse, also pose a challenge. While some IT companies serve local businesses, the troubles in the US and Europe, especially in the banking sector, will likely impact IT stocks. As for whether it's the right time to buy for long-term investors with a 3 to 5 year horizon, a systematic investment plan SIPE approach can be considered. This involves buying a quantity of shares now and adding to the investment monthly. Top IT companies like Infosys, TCS, and Wipro could be considered in this approach. However, for those looking to invest a lump sum, it may not be the most opportune time, particularly as Indian markets are facing challenges. One can observe this trend in the FIED, foreign institutional investor and domestic data, where continuous selling has been recorded this month, indicating caution in the market. Over the past several months, specifically from November to February, foreign investors had been buying in the Indian market, which led to a market rally. However, a noticeable shift occurred from December 2021 to June 2022, covering a 7-month period during which foreign investors consistently sold significant amounts, ranging from 40 to 45,000 crore rupees each month. This structural change has raised concerns about the Indian market's performance. India stands out negatively in 2023, as it's the only major market that has experienced a decline of more than 10%. Conversely, most major global markets have been performing well. This structural issue has impacted various sectors, with the IT sector being particularly affected due to problems in the US banking industry. Considering these factors, if I were to invest a lump sum amount, I would wait for at least another year until the situation in the US stabilizes. Currently, the US Federal Reserve is consistently raising interest rates, which has exposed vulnerabilities in the US banking sector. This instability is also reflected in the Indian banking and financial sectors. Consequently, it is likely to have a ripple effect on the IT stocks. For long-term investors, there may be opportunities as stocks are trading at attractive valuations. However, patience is crucial. For those interested in investing, a systematic investment plan, SIP, is advisable. while a lump sum investment is not recommended at this juncture. If you are a momentum investor, it might be wise to wait for the situation to stabilize before entering the market. Please note that I am not a SEBI-registered investment advisor or a certified research analyst. These are my personal views, and I recommend consulting your financial advisor before making any investment decisions. Thank you for watching this video.